When we say export finance, it is a cash flow solution for exporters. It allows businesses that sell products or services to another country to get access to cash before their clients pay for the products ordered. This process is also called invoice factoring or simply invoice financing. Export finance facilitates the commerce of goods internationally. Working capital. The funds you have on hand to cover your immediate urgent commitments are known as working capital. You must estimate your present levels, forecast your future requirements, and think of strategies to guarantee that you always have enough cash to meet those needs if you want to make sure that your working capital serves your needs. Trade creditors. Trade creditors are the bills you need to pay. They're sometimes called creditors. Trade creditors or accounts payables. Trade creditors might also refer to the suppliers you owe money to. It might help to think of trade creditors as bills that your business hasn't paid yet.
Unsecured loan stock, a deep instrument that is convertible into the ordinary shares of the company at a fixed price at the date or within a range of the dates in the future. Just like convertible unsecured loan stocks are just a bit like a dip and a bit like an equity. So, unsecured loan stock is a loan made to a company with no collateral. In many respects, unsecured loan stocks behaves like a bond or both offer fixed returns. Of course, they have maturity dates and so forth. However, unlike a bond, in the event of default, the holder of unsecured loan stocks does not have a claims to the company assets. For that reasons, unsecured loan stocks carries higher risk than a bond. So, in the other word, loan stock is a form of debt, which shares multiple features with the rest investment. Each stock issues by your business as a collateral against a loan. Just like other loans, it earns interest and gains control of the rest shares to the lender until the loan is paid off. Examples of unsecured loan stocks: students' loans, personal loans, and credit cards are all examples of unsecured loans. Since there is no collateral, financial situation give out unsecured loans based on large parts of your credit scores and history of repaying past debts. The convertible loan stock. Convertible loan stock is usually refers to the loans which may be converted into the share at the later date. Typically, the lender will be receive interest for the durations of the loan and will then either convert the loan principals to share or demand repayment, depending on which option is the most profitable. First, the student loan. Student loan, it is agreement by which a student at the college or university borrows money from the bank to pay for their education and then pay the money back after they finish studying and starting working. Next, a personal loan. It also known as a consumer loan. Describe any situation in which an individual borrow money for their personal need, including making investment in a company. Last, a credit card. A credit card works by letting you borrow money from the credit card issuer to buy goods and services. You then pay the amount you borrow back, either its full or its monthly installment. If you don't repay it full, you also be paying interest. You are able to spend up a certain amount on the credit card.
Overdrafts. An overdraft occurs when you don't have enough money in your account to cover a transaction, but the bank pays the transaction anyway. So basically, an overdraft means that the bank allows customers to borrow a set amount of money. There is interest on the loan, and there is typically a fee per overdraft.
So this is the importance of overdrafts. Overdrafts occurs when an account lacks the funds to cover a withdrawal, but the bank allows the transaction through anyway. The overdraft allows the customer to continue paying bills even when there is insufficient money. Many banks impose additional fees or penalties for overdrawn accounts.
So this is the example of overdraft. Financial report. The practice of conveying financial performance over certain time periods, often on a quarterly or annually basis, is called financial reporting. Financial reports are used by businesses to compile accounting data and provide information on their current financial situation. The financial report has the source of following data. Balance sheet. A balance sheet provides an overview of a company's specific point in time. It provides a picture of an asset, liabilities, and equity that makes a company financial situation. Purpose. In addition to listing the company assets and liabilities, a balance sheet serves as the goal of providing interest parties with information about the company's financial status. Profit and loss account, P&L account. A profit and loss account displays a company income and outlays over a specific time frame, usually 1 month or a year worth of consolidated month. This number demonstrates whether your company generates a profit or loss during that time. This is the example of profit and loss account. The profit calculation is broken down into these steps. Cost of manufacture. This represents the full cost of purchasing and producing the items for sale. Gross profit. A company gross profit is calculated by deducting its entire sales from its total cost of product sold. Net profit. Net profit is the amount of money your company makes during a specific time period, after subtracting all the operational, interest, and tax costs.
Management information. Internal stakeholders are kept updated on corporate activity through management reports. They are some of the internal reports that managers and senior executives use to govern the company, make decisions, and track development. Leadership uses management reports to keep an eye on their division. Managers get reports from their staff members, who then utilize those reports to update top management on status and educate them of strategic choices. Sales order. Sales order is a report that states orders are received, or a weekly or monthly sales overview. Figures for year-to-date and budget comparison are frequently used. When a seller receives a purchase order from a customer, the seller will create a sales order that includes information on the goods or services, price, quantity, customer information such as shipping and billing addresses, method of payment, and terms and conditions. Cash flow forecast. Estimating your upcoming revenues and costs is part of the cash flow forecasting process. A cash flow prediction is an essential tool for your company since it will let you know whether you'll have enough money to run or grow the enterprise. It will also let you know when the company is losing more money than it is making. The technique of projecting a company's cash inflow and outflow over a predetermined time period is known as cash flow forecasting. An accurate cash flow prediction enables businesses to estimate their future financial balances, prevent debilitating cash shortages, and maximize the return on any cash surpluses they may have. Cash flow forecast is also display the amount and timing of the period's income and expenses. For small businesses in particular, the link between capital flow into and out of a firm is crucial. Outstanding orders. Outstanding orders is when resolving clients' inquiries, sales administration will benefit from this report. More significantly, changes in order book size will provide early warning of impending threats. An increase in orders suggests a factory overload and swiftly appearing delayed deliveries, whereas a fall in orders predicts a decrease in cash revenues over the course of several months. Sales analysis. Management will be informed of changes in market circumstances or sales performance through a regular monthly or more frequent sales analysis. Investigations can be conducted and remedial measures can be performed before the business's commercial prospects are harmed. It is also the process of comprehending how well your company does in terms of revenue. You may use it to anticipate trends, find development opportunities, and create a strategic action plan for your organization since it offers insights into the past, present, and future performance of a firm. A sales analysis is a thorough report that details a company's sales performance, client information, and income earned. In order to identify developing trends that are most pertinent to a firm, the report identifies the strengths and weaknesses of goods and sales teams by referencing historical and current measurements. Stock levels. Sales orders will be included in good stock control systems, display of both allocated and free stock. It is also the amount of inventory necessary for efficient and effective product control, preventing both overstocking and understocking. Inventory control is necessary in order to keep the stock of items as low as feasible while yet making them accessible as when needed. The term stock level describes the quantity of products or raw materials that should be kept on hand by firm in order to sustain operation and prevent scenarios like understocking or overstocking. To guarantee the smooth running of its manufacturing processes, any business should constantly maintain an ideal level of inventory. Dispatches. Year to date, totals and budget deviations provide management with strategic direction. Comparison with prior dispatch timetables that made commitments highlights the company's current troubles. Debtors ledger. It is a section of an organization's books that displays debt. One of the secondary ledgers to the general ledger is a debtors ledger. It gathers the data as a result of the sales journal's monthly publications. The debtors ledger's function is to list which customer owe money to the company. As a result of the sales made on credit, along with their respective balances, debtors are the clients who owe money to the company. Age debtors report. It is when customers will be rated in this analysis based on the age of outstanding, unpaid debts, and individual L&C limit allowances. An age debtor report, also known as age receivables report, is a summary of all overdue sales invoices that break down their total debt per client. This debtor report provides you with a breakdown for each client and gives the total amount of debt each month. The invoice number, balance owed, and payment due date may then be seen by drilling down. Additionally, it will display any bills that have been sent beyond the due date or thus overdue, do not comply with your invoice payment terms, and require follow-up with the client. The entire amount of money you are owing by your client is expressed as age debt. Additionally, your debtor days number, a key performance indicator or KPI that is essential to every business cash flow, measures the average time it takes for consumers to pay.